Today I'm going to talk about something that is so important in accounts that it is one of the very fundamentals on which your entire basis of accounting is based, and these are all the practices that will last you a lifetime. So, without any delay, I would like to share a screen with you so I can explain further. Okay. So now we all know that for every transaction, there is a double entry. Now, all these double entries, why are there double entries? Because there are many accounts which are involved in a transaction. Now, what is an account? An account is a record of the transactions under a specific head. Now, what does it record? It records the amount, that is how much you received or how much you paid, and the effect. Now, what is the effect? The effect is going to be whether it is a gain or whether it is a payment. And who is affected, like who gave it to me or who I gave it to. So when we have a double entry, there is always two sides to a transaction. There is always a gain side and there is a expense side. Like if I have received something, now if I have a transaction and I received rupees 100. Now it can be that I am the receiver and the person who gave it to me, the person is the giver. Now, when we are going to record the transaction in an account, we use either the debit side or the credit side. What do we record in the account? We record the date. The date is when it happened, the particulars, that is who is the party involved. Then we have a journal folio number. This is something which is a different topic altogether. It would be when the topic is to be done. And the amount, that is how much is being received. The same way on the credit side. Okay. Now, the most important, this is just a basis of what is an account. Now, coming to the most important part of accounting. This literally creates the fundamentals of your accounting practices for a lifetime. Getting this right would be like everything is sorted. So there are two approaches to accounting. One is the traditional approach and one is called the modern approach. Now, today we will be understanding the traditional approach of accounting. Now, under the traditional approach, there are different account classifications. You have a personal account and you have impersonal accounts. Now, what are impersonal accounts? They would be real accounts and nominal accounts. Now, what are personal accounts? Personal accounts are any account that has a name like Ram, Sham, Varun, Amit, Aman, Dipti. So, and that is a person of individuals. Now, we also have like firms you are involved with. You are having transactions with a firm, say Messrs XYZ Limited. You have a furniture company. So, those as well would come under your personal account. Now, what are real accounts? Real accounts are all those which are like your assets. You have machinery account, you can have furniture, you have building, you have car, you have computers. So these are all your real accounts, which are your assets. Now, and then we have nominal accounts. Now, anything which is an expense, an income, a profit or a loss, these are all your nominal accounts. Now, for example, expense is you have rent, you have salary, you have an electricity bill, then you have discounts received, discounts given, So these are all kinds of nominal accounts. Going further into how you would post your transactions, uh, we have understood our classifications. So when we look at a transaction, what we need to identify is which are the accounts involved. Classify those accounts under these heads and then apply the rules. Okay, let's start with an example. Now, if Amit has given me cash, rupees 100. Now, if Amit has given me cash, the two accounts involved in this are Amit and cash. Now, who is Amit? Amit is a personal account. Why? Because it is a person. Now, when Amit is a person, what is he doing? He is giving me the cash. So what is he? He is the giver. So his account would be credited. What is the rule of posting an entry for a personal account? When it is the receiver, he would be on the debit. When it is a receiver, he would be on the debit. When he is the giver, he will be on the credit. So in this case, Amit gave me rupees 100, so he is the giver. So he will be on the credit side. Now coming to real accounts. Real accounts are assets, property. Now cash is an asset. So it is a real account. Going to the rule, I received the rupees 100. So what happened? It came in, or did it go out? It came in, right? So what will it be? It will be a debit. When the money came in, the cash came into me. I got rupees 100. So cash is on the debit. Similarly, when we have an expense, when we have a nominal account. Now, what will be the nominal account? It will be rent, it is salary, it's discount received, discount given, electricity bill, traveling expenses, postage, stationery. So all those kinds of items or transactions will get posted on what is the rule? When it is an expense or a loss, you will debit it. When it is an income or a gain, you will credit it. Let us go back and refresh our rules of accounting. For personal accounts, debit the receiver, credit the giver. For real accounts, debit what comes in, credit what goes out. And for nominal accounts, debit all expenses and losses and credit all incomes and gains. Now, the fundamentals under a modern approach of accounting are a little different from this, but the journal entries which we would prepare ends up to be the same, whether you follow the traditional approach or whether you follow the modern approach. The crux is follow only one of them. You can't follow both, otherwise it would be a complete mix-up. So coming to this, I think it seems easy. Yeah. So going back to how we learned about the golden rules of accounting, I think learning accounts can be very easy even virtually. And once you understand the basis of accounting, not only the golden rules, but also how we do the transactions, how we classify them, how we understand the way the transactions go on, we will understand better into how you are supposed to record them. And this makes it easy. Thank you.